let's just jump right into it, shall we? Today, we're doing a rigorous forensic valuation of PTC Therapeutics. We are putting on our professional equity analyst hats and trying to uncover the absolute true intrinsic value of this company. We're going to take the raw metrics, the cash flows, the balance sheet data, and run them through an absolute gauntlet of valuation models. If you want to know what PTCT is actually worth, totally stripping away all the market noise, well, you're definitely in the right place. To do that, we'll systematically interrogate the stock using a strict 5-phase toolkit: the baseline, absolute valuation, relative valuation, asset-based valuation, and finally, synthesizing value. All right, let's get into it. Starting with phase 1, the baseline, and what I like to call the mystery of PTCT. Because look, every great investigation has to start with a known fact, right? Before we can truly evaluate the stock, we have to establish exactly what the market is asking us to pay for it right now. So the crucial data point to ground us is the last closing price of $65.15. Now you multiply that out by the outstanding shares, and we get a market cap hovering right around $5.39 billion. And hey, looking at recent performance, PTCT has actually put up a pretty impressive one-year return, over 31%, even though it's taken a bit of a hit, down about 14% year to date. But as we all know, price is simply what you pay. Value is what you get. So let's dig in and find that value. Moving right along to phase 2, absolute valuation models. This is where we attempt to pinpoint the company's value based strictly on its own internal cash-generating power, totally ignoring whatever the broader market or its peers might be doing. Let's pull out our primary tool for this, the discounted cash flow or DCF model. We're going to follow 4 very precise mathematical steps to basically drag future cash back to today's value. We project out the free cash flows to the firm, discount them using a solid weighted average cost of capital, calculate a terminal value for when the company reaches maturity, and then simply divide by the implied shares to get our per share intrinsic value. Now, the source data gives us a wildly strong starting point here. We are looking at a trailing 12-month free cash flow of $702.34 million. And get this, their free cash flow compound annual growth rate over those trailing 12 months, it's a staggering 644.7%. I mean, wow. But because our source data doesn't give us multi-year forward projections, I've gone ahead and applied some very sensible default assumptions for our model. We're using an 8 to 10% discount rate and a super conservative 2.5% terminal growth rate, just to stress test that absolutely explosive historical growth. Oh, and based on the market cap, we're calculating roughly 82.8 million implied shares. Okay, so crunching all those inputs together, the math spits out a calculated DCF fair value price of exactly $64.13. This is our anchor. Based purely on the cash this business is throwing off right this second, plus some very reasonable expectations for the future, the absolute value of one single share of PTCT is sitting at roughly $64.13. But wait, as thorough equity analysts, we can't just call it a day after looking at free cash flow, right? You might be sitting there wondering, hey, what about the dividend discount model? It's an absolute staple for a lot of valuations, especially when looking at more mature companies. Well, we kind of hit a brick wall on this one. The data clearly shows that PTCT has a 0% dividend CAGR. They literally do not pay a dividend. Because of that, the present value of expected future dividends is just 0. So, this specific model yields an intrinsic value of exactly 0, making it completely and totally useless for valuing a growth-oriented biotech company like this. Okay, so what about the residual income model? The formula here usually starts with the current book value of equity, and then we add the present value of future residual income, which, simply put, is just net income minus an equity charge. But as we're going to see in just a minute when we peek at the balance sheet, relying strictly on standard book value inputs for PTCG gives us incredibly fragile, almost nonsensical results. We're going to have to table this model for a second, but definitely keep a pin in that thought about their equity. All right, on to phase 3, relative valuation metrics. Absolute models really only tell us one side of the story. So let's pivot and look at how PTCT is priced based on its earnings and sales multiples when stacked up against expectations. Now, there is a massive discrepancy to consider here. The trailing 12-month price-to-earnings ratio is sitting at a remarkably low 8.42. At first glance, that makes the stock look ridiculously cheap, like practically a value trap. But then, consider the forward PE ratio. It's 55.25. This is telling us a completely different, absolutely critical story.
The market is basically expecting their earnings to drop significantly, or at least normalize, in the coming year, and it's slapping a much steeper premium on those future earnings. You just cannot value this stock solely by looking in the rearview mirror at last year's phenomenal, but probably anomalous, net income growth of 287%. Digging a little deeper, when we look at enterprise multiples to strip out the debt structure, the EV to EBITDA ratio of 6.11 is actually really healthy. And moving over to revenue, the price to sales ratio is 3.12 and EV to sales is 3.16. Honestly, these figures are surprisingly cheap for a biotech company boasting a massive 96% gross profit margin. And finally, that PEG ratio is sitting at practically zero, just 0.03. This strongly suggests that at least relative to its historical growth efficiency, the stock has been trading at a pretty massive discount.
Let's move into Phase 4, Asset-Based Valuation, or NAV. It's time to turn over another rock and subtract liabilities from the fair value of assets to see what the raw, bare-bones parts of this company are actually worth. And this is where the narrative takes a really fascinating turn. Think about these figures for a second. A price-to-book ratio of negative 25.85 and a debt-to-equity ratio of negative 12.67. Yes, you heard that right, negative. PTCT essentially has negative equity. Its liabilities are completely swallowing its assets on the balance sheet. Now, before you hit the panic button, we have to remember this is actually pretty par for the course in the biotech sector. You have years and years of debt-funded R&D accumulating as a giant deficit, long before a single drug ever gets commercialized. But strictly speaking from our analyst perspective today, it means a traditional net asset value calculation is effectively negative, rendering it totally unusable for setting an intrinsic price floor. That brings us to our final stop, Phase 5, synthesizing intrinsic value. We have pushed the raw data through every major model in our toolkit. Now, let's weave these disparate metrics together into one coherent, final verdict for PTC Therapeutics. Synthesizing all of this together, the dividend and asset-based models completely broke down due to PTCT's specific biotech structure, obviously no dividends, and that negative equity we just talked about. The relative valuation gives us a bit of a split decision. It looks deeply undervalued if you're looking backwards, but fully valued or even a bit overvalued when looking forward. So by process of elimination and sheer rigor, that leaves the free cash flow DCF model as our most reliable North Star, pinning the intrinsic value squarely at $64.13. When you stack the current market price directly up against our most rigorous absolute valuation model, the comparison is pretty striking, isn't it? The market price and the fair value price are almost identical. The market is out there asking for $65.15, and our math is telling us the company's cash flows justify $64.13. Which gives us a calculated margin of safety of negative 1.59%. And look, in the world of equity analysis, anytime you get within a few percentage points of zero, it means the stock is trading right at, or maybe just a tiny hair above, its absolute perfect intrinsic value. The market, believe it or not, seems to have priced the current cash flows of PTC Therapeutics with near perfect efficiency. There is no deep hidden discount here. The stock is, for all intents and purposes, fairly valued. But with the mass aligning this perfectly, you really have to ask yourself a much bigger question. In a sector as historically volatile and pipeline-driven as biotech, is a perfectly fair valuation actually just the calm before the storm? Are these highly efficient current cash flows the absolute peak? Or is there some massive game-changing clinical catalyst waiting in the wings to completely rewrite this valuation tomorrow? That is the billion-dollar question you need to figure out next. Thanks so much for joining me on this deep dive. Keep analyzing, keep questioning, and I will see you in the next explainer.